Hey, what's going on, everyone? Christian Carter with Radius Financial Group, and I'm doing another video this week on the top 10 most Googled questions in 2022 by potential home buyers. And this week's question is fixed rate versus adjustable rate, right? What is the difference between the two? Long story short, the difference between a fixed rate and an adjustable rate is essentially how the interest rate is determined and whether or not that interest rate can change over time or if it's fixed over time, right? All right, so let's get right into it. We'll hit on fixed rate first and then we'll jump over to adjustable rate. All right, so fixed rate, just like it sounds, it's fixed for the entire length of the loan or mortgage, right? So that interest rate is not going to change month to month, year by year, anything like that. Once you lock in a fixed rate, it is fixed as long as you keep that mortgage or loan, right? Now, an important point here is once you go to refinance, once you sell the home or anything like that and go to get a new loan, you'll then be subject to the new interest rate, right? So, but as long as you live in that home and keep that loan or mortgage with a fixed rate, it's going to be fixed for the entirety of that term. Now, your fixed rate, it might be slightly higher than an adjustable rate because we'll get more into that on the adjustable side. But just know that the fixed rate is most likely going to be slightly higher than the initial adjustable rate mortgage, right? Now, because the fixed rate is fixed, your monthly payment is fixed, right? Now, we're just talking about principal and interest here, so paying back the loan. Your real estate taxes could go up over time. Your home insurance could go up over time, which would raise your monthly payment. But for the most part, your monthly payment is going to be fixed. And that's going to allow you to budget a lot easier, right? Last point right here on fixed rate. Typically, you're going to want to use a fixed rate if you're in, for example, your forever home, right? So if you're not going to be selling the home soon, or taking money out of your home or something like that, then typically a fixed rate might be a better option, right? All right, fixed rate is pretty easy. Adjustable rate, couple more nuances in there, right? So adjustable rate, also real quick, if you ever hear the term ARM, A-R-M, that's just an acronym that stands for adjustable rate mortgage, right? So a lot of times you'll hear the term ARM instead of saying out the entire adjustable rate mortgage, right? So just like it sounds, an ARM or an adjustable rate changes over the term of the loan based off a specific benchmark interest rate or based off an index. And I can tell you that 9 times out of 10, it is most likely going to be based off an index, right? So some of the popular indexes or indices that mortgage lenders like to use, you've got the prime rate, you've got the LIBOR, which of course stands for London Interbank Offered Rate. That's a mouthful. And then US Treasury bill rate. An adjustable rate is typically going to be lower at first, right? Because there has to be some sort of teaser or some sort of incentive to make you choose the adjustable rate over the fixed rate, right? So 9 times out of 10, you're going to see a lower initial rate with an adjustable rate. But that interest rate could change, right? And with that, your monthly payment could change. So if interest rates go up over time, that would increase your interest rate, which in turn would increase your monthly payment, right? Vice versa, if interest rates go down over a period of time, then your monthly payment would go down as well because it would reflect that interest rate reduction, right? Now, when you're thinking about an adjustable rate, a lot of times on HELOCs, home equity lines of credit, those are going to be adjustable for the most part. Commercial loans, a lot of commercial loans are fixed for a certain period of time and then switch into an adjustable phase. And then typically during the construction phase of a construction loan, so like the draw period when you're building a home or something like that, you're most likely going to have an adjustable rate. Now, good question that we get all the time is, why the heck would anyone go with an adjustable rate? Well, there's a lot of good reasons. First of all, you may not have the choice, right? So if you're getting a home equity line of credit, you might not be able to fix that interest rate. It might just be adjustable, and there's nothing you can do about it. Secondly, most mortgages do not last 30 years, right? Because the homeowner either sells the home and buys a new home, or maybe they have to do a cash out refinance so that they can pay to send a kid to college, or they can pay to put an addition on, or a new deck, or something like that. So most mortgages do not last the full 30 years. So it might be more advantageous, for example, if you're only going to be living in the home for 5 years, why not look at a 7/1 adjustable rate mortgage? Because, like I said, you're going to be paying a lower interest rate at first, and then you're going to be selling the home after a certain period of time before that interest rate has a chance to fluctuate. So I hope that was informative. Fixed rate versus adjustable rate, pretty straightforward. But of course, if you have any questions, please feel free to reach out to me. And if you have more topics, I need more topics to make videos. So please reach out to me as far as that. Other than that, have a great day. See ya.